768,000. We less the exempt, which is 3,670,000. This is basically exempt, and exempt, that is 3,670,000. Then we less the zero rated. Zero rated in this case is about a figure of 1.5. Zero rated is a figure of 1.5. So we get the standard rate. We get the standard rate. We get the standard rate. So for the standard rate, we pick that, and we will say 8,768,000 minus 670 minus 1.5 minus 1.5. So we have the standard rate sales to be 3,598,000. 3,598,000. An explanation on that. So we know that standard rate, those are taxable, and the zero rates are also taxable or vatable. But zero rate, we know we claim VAT at 0%. Exempt rate, exempt sales, we do not charge VAT at all. But we know that standard rate, those are taxable, and the zero rates are also taxable or vatable. But zero rate, we know we claim VAT at 0%. Exempt rate, exempt sales, we do not charge VAT at all. But we're saying that these figures on sales are basically what we call output VAT, and I've explained that exempt, we don't charge VAT, not chargeable to VAT. Zero rate, import, export is zero rated. Then standard rate, we charge VAT at a standard rate of 16%. So then we're being told that the company received a credit note. A company received a credit note and a debit note worth 600,000 and 540,000 respectively. So if I just indicate here, just to indicate working three, we say that a credit not received, credit not received. Remember this, credit not received affect purchases. Affects purchases. We know that this basically affect the purchases. This basically affect the purchases, and credit note will reduce the purchases. Reduce the purchases. That will definitely reduce the purchases. Then the second, we have debit note. Debit note received. Debit note received. Received. That also affect purchases. And we know that debit note is used to correct an undercharge. So this definitely will increase purchases. This will increase the purchases. That is analysis for that. That definitely will increase what you call purchases. So then we are being told that during the month, the company purchased a motor vehicle on hire purchase at shillings 4.5 million to be used in business. The cash price was 3.8. If you have the hire purchase and the cash price, we basically use the cash price to claim input VAT. So the input VAT will be on the 3.8 and not 4.5 So we proceed to the additional information number 6. Additional information number 6. The company imported goods valued. 2.4, that is cost, insurance, and freight. They incurred clearing. They incurred what you call the clearing. They incurred the clearing. The company incurred the clearing and transport of for 50,000 and 150 respectively. Respectively, this import was not included in purchases above. The import duty rate during the year was 25%. The import duty rate was basically 25%. So we go to working for. Working for on import. Remember, when you talk about import, we say that import basically has a cascading effect, meaning that we charge VAT after charging input duty. So input duty is charged. Input duty is charged on what you call the CFI, cost, insurance and freight. So we have the cost, insurance and freight to be a figure of 2.4. So 2.4 to get the input duty 25%. So we get 25%, we can get the 25% and add, or we just have plus 125 over 100. Instead of getting 25, then we get 2.4, we get 2.4, 125 over 100, meaning the figure plus the input duty. We can test that with our calculator. So we have that 2.4. The figure is 2.4 times 125 over 100. So the figure is basically 3 million. But you know that imports are exclusive of VAT. Imports are exclusive of VAT. Imports are basically exclusive of VAT. And when you look at the figure for the transport and clearing, those are also input, but we're going to charge them. Those are basically input. VAT. So we proceed to 7, additional information number 7. So the company incurred the following expenses. Expenses are basically input VAT. So the first expense is what we call legal expense. Legal expense is vatable. We charge input VAT. Salaries and wages are exempted from VAT. Office rent, that is chargeable to VAT. We claim an input VAT. Then we have water from the county. That is basically exempted from VAT. Water from the county, that should not be charged to VAT. Then we have electricity, that is chargeable to VAT. Then we say 8, the company could not identify. We're being told that the company could not identify a goods sold as exempt when they purchase, and therefore restricted deductible input VAT. So we have restriction in that. Then the last additional information, that is additional information number 9, transactions are inclusive of VAT at a standard rate of 16%. So when you're told transactions inclusive of VAT, transactions inclusive of VAT. So means that VAT is already charged. So we say into bracket use 16 over 116. Use 16 over 116. If the transactions are inclusive of VAT, it means that VAT is already charged on that. So we basically use 16 over 116. So we proceed to what is required. Determine the value added tax payable or refundable to lesser limited for the month of May. So we can say VAT payable or refundable to lesser. We say to lesser limited, payable or refundable to lesser limited. Particularly on questions that we have restriction, one of the best approach to take, especially on questions that we have on restriction, is basically to do the output separate and do the input separate. Sometimes students mix them, but the best approach to take when it comes to questions that basically deals with the restriction is to have the output separate, and also do the input separate. So we go to the output, we get the output VAT. So on the output VAT, we have standard rate. We have amount here. Then we have the VAT rate. Then we have the VAT. So we have item on that. So the first item is standard rate cells, standard rate cells. And the standard rate cells, we had done the figure as we rotate the camera. As we rotate the figure for the standard rate, we less the exempt and zero rated. We had the figure of 3,598,000 times 16. Transactions are inclusive of VAT. So we have our calculator, and 3,598,598, then times 16 over 116. So the figure that we have for that should be a figure of 496,276. That is for the standard rate cells, a figure of 496,276. The next items on cells, we have what we call zero rated, zero export. And when you read the additional information number 3, export to South Africa. So export was a figure of 1.5. Export was a figure of 1.5. Remember zero. There's zero rated. So that is 0. That is 0 on that. Then you have exempt. Exempt, we have at a figure of 3,670,000. We don't charge VAT at all. So then down here we have what we call total output VAT. Total output VAT. That should be a figure of 496,276. 496,276. We proceed to the input VAT. We get the input VAT. We proceed to what we call input VAT. We have what we call input VAT. So on the input VAT, we have item on this. Item, amount. We have the VAT rate. Then finally we have the VAT. And we move sequentially. So the first item that we had was credit sales, credit purchases. We charge VAT on the credit purchases. So credit purchases, a figure of 4,750,000. The VAT rate, because it's inclusive, 16 over 116. So we pick our calculator, and we have that. We pick our calculator. So we basically, as we pick our calculator, we know that 4,750,000 times 16 over 116. So we have, on that we have a figure of 655. 655 to all number, that should be 172. 655, 172. We proceed to what we call the cash. We call it cash purchases. So on the cash purchases, there is a working basically on the cash purchases. There's a working on the cash purchases. We say that some of the purchases did not have physical document. So the working basically will less to 180. So for the cash purchases is a figure of 2.8. So we have the 2.8 at this point. Then we multiply by the rate which is 16 over 116. We get the figure on that. So we have 2.8 times 16 over 116. So that should be about a figure of 386, 207. 386,207, to rounding it to all number. We proceed to the next. We had what we call credit not received. That's the reduction of purchase. So we have credit not received, credit not received. We had a credit not received. So on the credit not received, the company received credit note and debit note. So credit not received was a figure of 600,000. That is additional information number 4. So credit note basically reduces the purchases. So times 16 over 116. So what do we get when you have that? So 600,000. 600,000 times 16 over 116. So that should be about a figure of 82, 759. 759. Then debit note received. That is used basically to correct an undercharge. An undercharge that should increase the purchases. So we have a figure of 540, a figure of 540, 16 over 116. A figure of 540, 16 over 116. So 540 times 16 over 116. So the figure that you have, that should be about 74, 483. 74, 483. 74, 483 as the figure. 74, 483 as the figure. Then there was an entry that was not basically added, opening inventory. So we had the first entry on opening inventory. On the first month, you can claim that opening inventory. Opening inventory. So the opening inventory was, we had a figure of 813. 813 times 16 over 116. The opening inventory. 813 times 16 over 116. So that should be a figure of 112, 130, 112, 138 as the figure. 112, 138 as the figure. So we proceed to the next. We had, during the month, the company purchased motor vehicle on hire purchase. We use the cash price. Motor vehicle. We have the motor vehicle. So motor vehicle is basically a figure of, we use the cash, which is 3.8, 16 over 116. 16 over 116. So we have the 3.8 times 116 over 116. So that should be about a figure of 524. That should be a figure of about 524. 524, 138. 524, 138. 524, 138. The next item was basically on import. We know that import, we have done the working. As we rotate the camera, import, we basically are done the working. Import plus import duty, we have a figure of 3 million. And you know that import are normally exclusive. Even if the question is inclusive, they're normally exclusive. So we have import. Import, a figure of 3 million. 3 million. Then that 3 million, we have times 16 over 116. Times 16 over 116. So 3 million, 16 over 100, sorry, because that is exclusive. So that's 3 million. Times 16 over 100. So that should be definitely about 480. 480. That should be 480. Then you have those transport. We have the transport. Remember, those are the point of entry. So those are basically inclusive. Transport cost, clearing. We have clearing cost. So clearing cost and transport clearing is 450. So for 50,000 times 16 over 116. 16 over 116. So we're having 450 times 16 over 116 for the clearing. So the figure should be 62,069. 62,069. Then we have the transport. Transport is a figure of 150. 16 over 116 for the transport. So transport should be 150. 150 times 16 over 116. So we have a figure of 20,690. That should be a figure of 690 for that. So then we proceed to the additional information. We have legal. Legal, we said legal are not exempted. Legal, we have the legal expenses. So legal expenses, which we claim VAT. So that should be 350. 16 over 116. 16 over 116. 16 over 116. So 350 times 16 over 116. So the figure for the legal, that should be 48. We have 48 to 76. 48 to 76. 48 to 76. Then you have the next, salaries are exempted. You know, salaries and wages, salary and wages. We know that salaries and wages, these are basically exempted. So the figure was 133400. We know that these are exempted. Then we have office rent. Office rent. We claim input VAT. That should be 580. 580. 16 over 116 for that. 16 over 116. So we have a figure of 580 times 16 over 116. That should be about 8,000 for that. Then the next we have what we call, we don't even to put it there. That is water from the county, that is basically exempted. Then we have electricity. We can have the electricity. Electricity is a figure of 54, inclusive of VAT, 16 over 116. 16 over 116. So electricity is 54. 54 times 16 over 116. So the figure should be, that should be 7448. So that was 655, 172 plus 386, 207, 386, 207, 207, then minus 82, 759. So start again, 655, 172 plus 386, 207, then minus 82, 759, then plus 74, 483. 74, 483 plus 112, 138, 112, 138, then plus 524, 138, then plus 480,000, for 80,000 plus 62, 62,069 plus 20 690 plus 80 plus 80,000, then plus 7,448. When we add that, that provides total. We have a total input VAT, total input VAT of 2,367, 862. 2,367,862. 2,367,862. Look back at our statement. That is statement 8. The company could not identify goods sold as exempt when they were purchased and therefore restricted deductible input VAT. So there is restriction. So we need to restrict input VAT. So how do you restrict input VAT? We say that taxable supplies over what we call total supplies times total input VAT. So we say that taxable supplies is equals to standard rate plus zero rate. Standard rate plus zero rate. Then we say that total supplies is standard rate plus zero rate plus exempt. And when we are restricting NB, when restricting standard rate cells should be exclusive of VAT. When restricting, the standard rate cells should be exclusive of VAT. So we have a figure of the standard rate cells. The figure for the standard rate cells. This is a figure of 3,598,000. Remember, this figure was inclusive of VAT. So that implies that the figure is 116%. We make that figure exclusive. Exclusive is 100%. So 100%, basically we say 100% over 116 times 3,598,000. So exclusive standard rate exclusive of VAT. So we have that figure. So we have our calculator. That should be 100 divided by 116. Then we multiply by 3,598,000. So we have a figure of 3 million. We round it off. 101,724. 724 as what we call the standard rate exclusive of VAT. So we can get taxable supplies. So we can get taxable supply, which is zero rated plus zero rated taxable supply, zero rated plus standard rate. Taxable supply should be 3,101,724 plus 1.5, which is zero rated plus 1.5. So that gives us total taxable supplies to be, so plus 1.5. Plus 1.5, we have a figure of 4,601,724. 724. Then you can have total supplies. Total supplies. Total supplies, we say that should be a standard rate, which is 3,101,724, plus zero rate, which is 1.5, plus zero rate, which is 1.5, plus the exempt, Exempt is a figure, if you look at that paper, on additional information number 3 is a figure of 3,670. 3,670. So we get the figure. Then plus 3,670. So that should be 8 million. Total supply should be 8 million to 8 million. 271, 8,271, 8,271, 724. So we restrict. At that point we restrict. At that point now we can restrict. We can restrict at that point. We have our formula for restriction. Taxable supplies. Taxable supplies is 4,601,724 over what you have as 8,271,724. Then times total input VAT, which is 2,367,820. 862. So that is deductible or restricted deductible input VAT. The input VAT, deductible input VAT. So we have a figure of 4,601,724 divided by 8,271,724. So the figure is 0.55 times 2 million, 367, 862, having a figure of 1,317,289. 1,317,289. So then we can get VAT payable or refundable. VAT payable, stroke refundable. That should be output VAT minus deductible, what you call the deductible input VAT minus the deductible input VAT. So we have the output VAT still here. That should be 496,276 minus 1,317,289. So we have, this is basically a refund. So when you say VAT payable, then you put it into bracket. But when you say VAT refund, this is basically VAT refund. So that should be a figure of 821,013. When you say VAT payable, that should be into negative. That should be that. So that is how we particularly. But maybe just an emphasis on how an approach is very important. When you look at these values, remember what is of key is the entries. These are entries that are being marked. For exempt may not be marked. When you have this entry, entry, these figures. These figures are the ones that basically constitute the solution. The most important part is those figures, understanding those figures. That is what basically would provide us with the solution. So as a learner, very important to understand is that to follow the procedure. You may not understand a few points here and there, but as long as you are doing your entries perfectly well, you can have about, let's say, 80% to 100% of the entries, you are in a good direction. So the key thing is to understand those entries and make sure that you make as many entries as possible. And when we do that, we will perfectly be handling those questions pertaining to the administration of VAT. That marks the end of our session. We meet in our next session.
Greetings to you all and welcome to the lesson. The subject is business and data analytics. We've been studying the first topic, Introduction to Data Analytics. So far we've done the CRISP, which is an acronym for the Cross-Industry Standard Processing for Data Mining Framework. Under that subtopic, we discussed the data concepts, the conceptual concept, logical concept, physical, and also physical data models. We went through the stages in data life cycle. Then in the second subtopic, we've begun looking at big data and data analytics. We, in our last lesson, defined big data. In our today's session, we're going to describe the 5 V's of big data. The 5 V's of big data. And to remind you, candidates, big data, as the name suggests, is data that is very large. Big data is defined as very large data sets having large, varied, and complex structure, with difficulties of storing, analyzing, and visualizing for further processes or results. So big data is a combination of the unstructured data, the semi-structured data, and the structured data. All right? Big data is a combination of data that is unstructured, semi-structured, and structured. Unstructured, semi-structured, and structured. Do you understand? And big data can be mined to gain insights, leading to predictive modeling and other advanced analytics applications. Big data can also be used to improve operations. Big data can be used to provide customer service. Big data can be used to create personalized marketing campaigns. And all that increases value. Okay? And as an example, big data can provide companies with valuable insights into their customers that can then be used to refine marketing techniques to increase customer engagement and conversion rates. And organizations that use big data have a potential competitive advantage over those that don't have, since they make faster and more informed business decisions as provided by the data. So in our today's lesson, we are going to describe the 5 V's of big data. So by the end of the lesson, you should be able to describe the 5 V's of big data. And these V's also help us to understand characteristics of big data. The V's are: 1, volume; 2, variety; 3, velocity; 4, veracity; 5, value. 5 V's. 1 V, 2, 3, 4, 5. 5 V's. The first one is volume. Volume refers to the quantity of data. Volume refers to the quantity of data. It refers to the amount of data that exists. And volume is like the base of big data, as it is the initial size and amount of data that a company can collect. And if the volume is large enough, it can be considered big data. But we know what is considered to be big data is relative. What is big data to company A may be small data to company B. And may also change depending on the available computing power that is on the market. So volume refers to the quantity of data. Number 2, variety. Variety, on the other hand, refers to data types. Refers to data types. Because we have diverse types of data, we have diversity of data types. An organization may obtain data from a number of different data sources, which may vary in value. Data can be obtained from outside an enterprise, or data can be obtained from within the enterprise. We saw earlier we have unstructured data, which we know is data that is unorganized and comes in different files or formats, such as texts, audio data, we have video format, log files, and so on. We have data that is semi-structured. This is data that may not have been properly organized into specialized repository, but it may have associated information. And it makes it easier to process it as compared to the unstructured data. But structured data, meanwhile, is data that has been organized into formatted repository, meaning that such data is made more addressable for effective data processing and analysis. So there are various data types depending on data that is received from different sources. Data may be in form of text, it may be verbal, it may be written, it may be in video format, data may be in audio format. Data may be obtained from without the organization, data can be obtained from within the organization. So this is a characteristic of big data. And I've said data that is structured is easier to process and analyze such data as compared to data that is unstructured. Then thirdly, we have velocity as the third V of big data. Velocity. Now, velocity refers to the time that is taken to process and analyze data. It refers to how quickly data is generated and how quickly data moves from point A to point B. And velocity is an important aspect for companies that need data to move quickly. There may be need to have quick data flow so that such data is available at the right time to make the best business decisions possible. And an organization that uses big data will have large and continuous flow of data that is being created and sent to different destinations. All right? Big data being generated quickly. Big data being processed quickly or sent to different destinations for processing. And we say that data could flow from sources such as machines, such as networks, such as smartphones. Data can flow from sources such as social media. And such data needs to be digested and analyzed quickly. And at times, such data ought to be analyzed real time. And I can also say that it may be better to have limited set of collected data than to collect more data that an organization can handle. Why? Because that can lead to slower data velocities. For what is the point of having big data that is not analyzed or that is not processed? So it's rather you have a limited amount of data that can be processed, that can be digested, that can be quickly analyzed, if possible real time, because at times information may be required, decisions may be required to be made real time. Therefore, data has to be made available for making such decisions. Velocity refers to how quickly data is generated and how quickly data is moved or flows from point A to point B. The fourth V is veracity. Veracity. Veracity refers to the accuracy of data. The accuracy of data. The correctness of data. The quality of data that is gathered. So gathered data could have sometimes missing pieces. Data gathered could also be inaccurate. And it may also not be able to provide real valuable insight. So veracity refers to the level of trust that a leader has in the collected data. Because sometimes data can be messy. Data can be messy, data can be difficult to use. And large amount of data can cause more confusion than insights. Especially if such data is not complete. So veracity refers to accuracy, refers to the quality, refers to the trust that the leader has in the information that is gathered. The correctness of data. So data that has missing, that is not accurate, that is data that cannot be relied upon in making decisions. So veracity is a very important feature of big data. Then we have value. Value. value refers to the value that big data can provide, the added value that big data can provide, and it relates directly to what organizations can do with the collected data. Because big data is only relevant or important if it adds value. Being able to pull value from big data is a requirement, as the value of big data increases significantly depending on the insights that can be gained from them. So it's not enough to have big data. It's not enough to just gather data and have data. The question is such data valuable to the organization? And organizations can use the same big data tools to gather and analyze the data, but how they derive value from that data should be unique to them. All right? So here data refers to the quality of data. The value, this we said refers to the quality of data. This is value added. Veracity refers to the quality of data. The quality of data. The accuracy of data. So, candidates, these are the 5 V's of big data. 5 V's of big data. The first V, volume. Volume. The second V, variety. The third V, velocity. The fourth V, veracity. Then lastly, value. We've said volume refers to the quantity, the amount of data. Variety refers to the data types, which could be unstructured, semi-structured, or structured. We say that data comes in different types, could be in different formats: audio format, text format, video format, log files, and so on. Velocity refers to the time that the organization takes to generate big data and to process or analyze big data. Veracity, on the other hand, refers to the accuracy or quality of big data. Veracity. Then lastly, value, which we've said refers to the value that big data can provide. We've said that it relates directly to what organizations can do with the data that is collected. We said collecting data is not enough. What is important is what value do you derive from the data that has been collected? And that brings the lesson to an end. The objective of this lesson was that by the end of this lesson, you, the learner, should be able to describe the 5 V's of big data, and that will form the basis of our today's assignment. Describe the 5 V's of big data. Thank you for attending this lesson. I hope to meet you in our next lesson. We'll continue to share knowledge in business and data analytics. Thank you. God bless you. Bye. Greetings, candidates, and welcome back to the lesson. The subject is governance and compliance audit. The chapter is post-governance and compliance audit. Now, in post-governance and compliance audit chapter, we only have 2 sub-chapters.
the one we studied in our last session, which is nature and scope of subsequent events. Then today we move to the general guidelines on subsequent events. Now, before we get into the guidelines, I want to reiterate that subsequent events, first of all, are significant occurrences, either favorable or unfavorable, that take place between the end of the audit period and the date the final audit report is signed. So in a governance and compliance audit, subsequent events are evaluated based on their impact on the audit's maturity score and the overall opinion on the organization's adherence to standards like the Institute of Certified of Secretaries of Kenya governance standards. And the subsequent events, they follow the logic of ISA 560, and due to that logic, they are classified into two, based on whether they confirm a pre-existing state or whether they introduce a new risk. That's why in our last session we said that subsequent events can be categorized into two, the adjusting and the non-adjusting events. There are two types. Type 1 is adjusting events. Adjusting events. Types A, adjusting events. This is just confirming. This is confirmatory. Events that happen after the end of the audit period and before or after the audit report is signed. So we have adjusting events. We've said in our last session that these events provide further evidence of conditions that existed during the audit period. And these events typically lead to change in the audit score or even modification of the audit findings. Examples of adjusting events could be legal settlement. Legal settlement. For example, a legal settlement. It could be a court ruling, say in March 2026, for a case that was active throughout the year 2025. So the audit period ends in, say, December 2025. This is the audit period ending December 2025, but in March 2026, this legal settlement, the court ruling in 2026, this is a subsequent event. This is an event that happens after the end of the audit period. Are you following, candidates? A legal settlement. So the ruling, this legal settlement only confirms whether the board's previous contingent liability, the contingent liability disclosure, it confirms whether the contingent liability disclosure was sufficient or if there was a systemic failure in the legal risk management. So this is an adjusting event. It confirms the condition that existed up to the audit period. That's one example of an adjusting event. Another example of adjusting event is discovery of fraud. Discovery of fraud. This means finding evidence, say in February. In February 2026, there is discovery of fraud. Okay? Finding audit evidence in February 26 of a kickback scheme. The fraud could be a kickback scheme that was operating secretly during the year ending December 2026. There was this secret scheme scheme, kickback scheme that was operating secretly during the audit period. But it has been discovered in February 2026. That is an adjusting event. That discovery proves that the internal control framework was not effective during the period under review. The period under review is up to December 2025. So the fraud is discovered in February 2026. This is a subsequent event. It happened after the end of the audit period. You understand? You may have things like tax audits. Tax audits. It could be a final assessment from the Kenya Revenue Authority that is received post-audit. After the post-audit, KRA conducts investigations or carries out an audit of the company, showing that, for example, tax filing errors were discovered and so on. Tax audit. That could also be a subsequent event that is that happens after the audit period. So these are just giving examples, candidates. It could be regulatory fines. Another example, regulatory fines. For example, receiving a formal penalty notice from the Office of the Data Protection Commissioner in, say, early January. It could be early January 2026. This is after the audit period. The company is fined. It could be for data breaches that occurred in 2025. And that confirms non-compliance with the Data Protection Act. That means that the company did not comply with the Data Protection Act in the year 2025. And that may happen post the date, okay, post audit date. So that is another example. So let's move to non-adjusting events. This is another type, non-adjusting events. Non-adjusting events. Non-adjusting events, these are disclosures. These are new events that did not exist prior to the audit period. These relate to conditions that arose after the audit period. These are conditions that arise after the audit period. They do not change the 2025 score, but they are so material that they must be disclosed to ensure the report is not misleading. One example could be board resignations. Say 40% of the board members have resigned. Sudden resignation of, say, 40% of the board. For example, the chair has resigned, the audit committee lead has resigned in January, immediately after the audit, or March or February. Now, while the 2025 board was stable, the 2026 board is now in a governance crisis. When you are auditing this company in 2025, the board was intact. But in February, 40% of the board members have resigned. So that is a non-adjusting event. This is an event that is arising after the audit period. It may not change the 2025 score, but is a serious matter that needs to be disclosed so that those who are relying on the 2025 report are not misled. Mergers and acquisitions. Mergers and acquisition. It is a merger or the company has acquired another company. Signing a deal to be acquired by a foreign entity 2 weeks, say, after the year 2025 audit period, that significantly changes the organization's stakeholder landscape. It is an event that did not exist in 2025, but in 2026, that is the position. We have merger or So that is another non-adjusting event. It could be major disaster. Major disasters could be a fire outbreak that demolishes the entire server room, a fire or a cyber attack in February 2026 that destroys the company's primary data center, and that tests the business continuity plan and must be disclosed as a significant risk to governance in future. It has to be disclosed. Example for new legislation. These are examples of candidates of non-adjusting event. There's a new legislation, for example, the enactment of a new law, or it could be change in a company, the Companies Act. So that did not exist in 2025, but that happens after 2025, say in February 2026. A new legislation that makes previous best practices now mandatory requirements. We are new provisions that did not exist in 2025, but because of the new law, what was regarded as best practice now becomes mandatory requirement. So that's it, candidates, for the types. We are discussing post-governance and compliance audit, the adjusting and non-adjusting events. This is just to reinforce what we did in our last session. So let's now shift to guidelines. That is our focus for our today's lesson. This was to reinforce what we covered in our last session, these events. Adjusting events, non-adjusting events. Today we are focusing on the general guidelines for auditors when it comes to subsequent events. Guidelines. Now, the auditor's objective, candidates, in regard to subsequent events is to ensure that the report reflects the true and current governance state of the entity at the time of signing. That's the objective. That's why an auditor has to conduct what we call proactive procedures. Proactive procedures. Because at the end of the audit period, as an auditor, you may not be aware of some of these events you are talking about. And that's why you need to be proactive as a governance and compliance auditor so that you can discover some of these guidelines. Because the objective, your objective as an auditor is to ensure that the report that you are issuing to the stakeholders reflects the true and current governance state of the entity at the time of signing that report. But you've seen there are some events that may occur, like the adjusting events, which may force you as an auditor to adjust your audit opinion. So that's why you have to be proactive. As the report date approaches, as an auditor, you should inquire with management. One, inquire with management. And what are you inquiring about? You need to specifically ask the CEO or the company secretary if any material non-compliance has occurred since the field work ended. Then you become another way proactive through reading. You read minutes before the report is signed. Read board minutes. Review minutes of any board or committee meetings that is held after the audit period. That would be, say, you check if there was if the audit period ends as we've been discussing December 2025, then you need to check if there was any board or committee meeting in January 2026, February 2026, March 2026. That is before the report is signed. You check if there were any changes or any information that relates to the subsequent events. 3. Search regulatory portal. Be proactive by searching the regulatory portal. Regulatory portal. Check for new filing on e-citizen or business registration service. Ensure there is no late filings or changes in beneficial owner during that period. So these are just 3 ways to become proactive. This is a guideline to help you ensure that the report that you are issuing is reflecting the true and current governance state. Then, of course, there is number 2, response to material deviations. Responses to material deviations. Responses to material deviations. If an event is discovered that significantly changes the governance score, then you can evaluate disclosure. One thing you do is to evaluate disclosure. Evaluate disclosure. Determine if management has disclosed the event in the notes or the chairman's statement. Then you can report modification. Report modification. What do we mean by reporting modification? That means that if the event indicates a systemic failure in governance, like massive fraud uncovered post-audit, then the auditor may need to modify the governance and compliance opinion. To modify the opinion if it is significant. That's a very important guideline. Then number 3, communication. Communicate. Inform those charged with governance immediately in order to discuss how the events impact the final scoring. You have to communicate immediately. Those charged with governance, that could be the audit committee, the board of directors, the CEO, the senior management, and so on, including the company secretary. Then, of course, another guideline would be in relation to the responsibility of management. Management's responsibility. Management's responsibility. What is the management's responsibility when it comes to subsequent events? Now, under the ICS governance standards, the responsibility to keep the auditor informed rests with management. So the management have a duty, first of all, to disclose. Duty to disclose. The management has a duty to disclose. The management must proactively notify the auditor of any significant fact that comes to light before the report is issued. Then they need to update the compliance matrix. They have a duty to update compliance matrix. The management have a duty to update the compliance matrix. That means that if a subsequent event resolves a previous gap, for example, a missing policy is finally approved, then management should update the matrix and provide the signed artifact to the auditor for verification. So that is the management's responsibility, and that is the end of the lesson on the general guidelines when it comes to subsequent events. And in closing, candidates, we need to remember that if a material fact becomes known after the governance audit report has been issued, then the auditor is required to take action. If that happens, number 1, the auditor has no legal obligation to perform further procedures, but there is one exception. The exception is if the fact is so severe that it would have resulted in a qualified or an adverse opinion, then the auditor should discuss the matter with the board, whether the report will need to be recalled or the report will need to be amended in order to prevent misleading the public or misleading the regulators. You understand? That is what we call the post-issuance fact. Repeating, if a material fact becomes known after the governor's audit report has been issued, after the report has been issued, then the auditor has little. The auditor can do nothing. But if that information is so significant, if the fact is so severe that if it was not before if it was known before the report is issued, if that information could lead to qualification of the report or making the report adverse, then something has to be done. You as an auditor, you should discuss the matter with the board as to whether that audit report is to be withdrawn or recalled or amended. And that is very important so that those who are using or relying on the report, like the public or the regulators, are not misled. So that is the end of today's lesson on the general guidelines when it comes to subsequent events. General guidelines on subsequent events. Thank you. God bless you. Bye-bye.
Greetings to you all and welcome back to the lesson. Today we are continuing with the subject strategic management. We've been studying business strategies and models. We've covered the generic competitive strategies. Today we move to the interactive strategies. Now, in studying interactive strategies, we are going to consider the interactive price and quality strategies. Then there is the cooperative strategy and the game theory. But first of all, what do we mean by interactive strategies? Interactive, from the word interact, to interact. Interactive strategies refer to a competitive framework where a firm's strategic choices are made based on the anticipated actions and reactions of other market players. This is unlike the generic strategies which focus on internal positioning. Greetings and welcome to the auditing learning session. Today we're moving to the second chapter, audit plan or plan for an audit. In this chapter, we're going to study the audit planning strategy, number 1. Number 2, objectives of audit planning. 3, development of an audit, overall audit plan. 4, development of audit programs. 5, limitations of audit plans. And lastly, international standards on auditing, on audit planning. So we'll be taking a subtopic at a time. Today we begin with audit planning strategy. Audit planning strategy. Now, in studying audit planning strategy, we are required to highlight 3 areas. That is the knowledge of the client's business, the degree of reliance on internal controls, and nature, timing, and extent of the work to be performed. But first of all, what is an audit planning strategy? Now, it's important to understand, candidates, that when embarking on an audit, just like any other assignment, it could be building a house or starting a course or getting married. If you want to embark on any assignment, you have to have a plan. And just like any other assignment, auditing requires a solid plan, which is essential for assuring efficiency, effectiveness, and also the ability to gather sufficient appropriate audit evidence. An auditor is required to express an opinion on the financial statements of an entity. For the auditor to express an opinion, the auditor is required to gather appropriate, sufficient evidence. Before then, the audit has to have a plan on how the work is to be carried out. So an efficient audit, an effective audit depends on how well the auditor has planned his work. So when embarking on an audit, a solid plan is essential to ensure efficiency, effectiveness, and the ability to gather sufficient appropriate evidence. So the audit planning strategy candidate sets the stage for the entire engagement. And if you are to define an audit planning strategy, we would say that an audit planning strategy is a high level. It is a high level framework that an auditor develops at the outset of an audit assignment or engagement. It is a high level framework. Audit planning strategy is a high level. It is a high level framework. It is a high level framework that an auditor develops the outset of the engagement, at the beginning. All right? It broadly outlines the scope, timing, and direction. It broadly defines the scope, timing, and direction of the audit assignment. And this is a strategic approach that is designed to help the auditor effectively allocate resources to identify and assess risks. It also ensures a thorough and efficient examination of the financial records. And in essence, candidates, is the auditor's game plan. It is the auditor's game plan. It is the auditor's roadmap. It is the game plan. It is the roadmap. The auditor, for engaging on the assignment, he has to have a work plan on paper on how the scope of the work is going to do. The strategy outlines the scope, the timing, what is going to be carried out, at what time will be carried out, and what direction. It is the game plan. It is the roadmap upon which the assignment is to be carried out. You understand? It's the auditor's game plan for how to approach a specific audit, considering the unique characteristics of the client's business, its environment, and the identified risks. The audit planning strategy then serves as the foundation upon which a detailed audit plan is developed, which specifies the concrete procedures to be performed. So an effective audit planning strategy involves several key considerations that guide the auditor's approach. And these key considerations include what we have here in the syllabus: knowledge of the client's business. So we have 1, knowledge of the client's business. I want you to understand, candidates, that an effective audit planning strategy involves several key considerations that guide the auditor's approach. So the auditor, first of all, has to gain deep knowledge. It has to gain deep understanding of the client's business. So gaining a deep knowledge of the client's business is the foundation step in the audit planning. Knowledge of the client's business. You cannot develop an audit planning strategy before knowing or understanding the client's business. And this isn't just about understanding their financial statements. It's about comprehending the intricate web of their operations. That includes knowing the key economic factors, the competitive landscape, the relevant laws and regulations that impact their business. For instance, an audit of a bank, say in Nairobi, will differ significantly from an audit of a manufacturing plant due to varying regulatory requirements and operational risks. A bank and a manufacturing company operates in different legal regulatory framework. So the knowledge that is required of an auditor when auditing a bank is quite different from when he's auditing a manufacturing company. So it's important to understand the intricate web of the operations of the firm or the client business. Gaining deep knowledge and understanding of the client's business is the foundation stone upon which an audit planning strategy is developed. You understand? Knowledge of the client's business. Knowledge of the client business. It may also include business operations and strategies. The auditor may require to know business operations and strategies. Business, apart from the business, the legal, the regulatory framework, there is business operations and strategies. As an auditor, before you develop a planning strategy, you have to understand the business operations and strategies. How does the client generate revenue? What are their core processes, products, and services? What are their strategic objectives, and how do they plan to achieve them? That's very important to know. Then there is a ownership structure, ownership and organizational structures. The auditor should gain understanding of the ownership and governance structures. Who owns the company? What is their organizational structure? Who are the key management personnel? And what is the tone? What is the tone at the top regarding financial reporting and regarding internal controls? Who owns the company? Who calls the shots? Who is the management? How is the management operate? You understand? You have to understand or know the ownership and governance structure. That will help the auditor know the business. Knowing the client business involves looking at the legal environment, the operations and strategy, and also the ownership and organizational structure. Then there is the aspect of accounting policies and internal controls. Accounting policies and internal controls. Accounting policies and internal controls. The auditor should find out what accounting principles that the company follows, how do they record transactions, what systems and processes are in place to ensure accuracy and prevent fraud, and all that. So by understanding these aspects, the auditor can identify potential risk of material misstatements. Then he can tailor their audit procedures and develop an effective audit planning strategy. So before you come up with an effective audit planning strategy, the auditor has to gain knowledge of the client business by understanding the operations and structures, ownership and governance structures, accounting policies, and internal controls. You understand, Carides? We are discussing the audit planning strategy. Then candidates, that is the knowledge of the business. That was one, knowledge of the business. Then number two, in developing an audit planning strategy, we are to discuss the degree of reliance on internal controls. Degree of reliance on internal. Degree of reliance on internal controls. Degree of reliance on internal controls. Now, the degree of reliance on internal controls is a critical decision in audit planning that directly impacts the nature, timing, and also the extent of substantive audit procedures. because internal controls are the processes designed and implemented by management to safeguard assets, to ensure the accuracy of financial records, and also to promote operational efficiency. So the auditor's assessment of internal controls involves understanding the internal control system first of all. It involves understanding the internal control system. Before the auditor relies on internal controls that are developed by the management, the auditor first of all has to understand the internal control system. And the internal control system can be on various aspects. It could be on purchases, internal control systems on cash, internal control system it could be on sales, and it could be on debtors, on creditors. So the auditor has to understand the entire internal control system. The auditor has to gain knowledge of the control environment. The auditor has to understand the risk assessment processes, the information system, the control activities, and even monitoring of control. So the auditor has to gain deep understanding of the internal control system, including the aspects that I've mentioned. A control system has various aspects which I've mentioned. One is the control environment, the risk assessment processes, information system. We have control activities and monitoring of controls. So after gaining understanding of the internal control system, then the auditor has to evaluate control design and implementation. Evaluate control. The auditor has to evaluate the control design and implementation. Evaluating control design and implementation. That means determining if the controls are appropriately designed to prevent or detect material misstatements, and if they are actually being put into operation. Because it's one thing to have controls on paper, but it's another thing to have the controls working out as designed. So the auditor should evaluate, first of all, if the controls are properly designed and if they are in operation. Evaluating control design, how the controls are designed, and if they are implemented. Understand? If they are actually being put into practice. Now the third aspect, before reliance on internal controls, is testing controls. Testing. The auditor has to do what we call testing. Testing the controls. If the auditor intends to rely on the effectiveness of internal controls to reduce substantive testing, the auditor must perform tests of controls to verify that the controls are operating effectively throughout the period. You understand? So there are times when the auditor may want to rely on internal controls. You recall in our previous session, we did mention that if the internal control system of an entity, if the controls put in place are strong, if the controls that are put in place are strong, then the auditor may put reliance on such controls by not conducting extensive substantive procedures. But if the controls are weak, then the auditor may be required to have to carry on his own tests to find to arrive at the audit conclusion or opinion. So before placing reliance on internal controls, first of all, we are saying here the auditor has to understand the internal control system, then evaluate the control design and implementation. And again, if the auditor is to rely on the effectiveness of internal controls, then he has to carry out, the auditor is required to test the controls. The auditor is required to do what? To test the controls. Testing of controls. The auditor is required to test controls. In order to reduce substantive testing, the auditor must perform tests of the controls to verify that the controls are operating effectively throughout the year. If the auditor fails to test control, then how then will the auditor have the confidence in the controls? So the auditor has to carry out his own tests. If there are tests on, say, inventory, the auditor has to carry out tests on controls on inventories. If the controls are in relation to cash, the auditor should test the controls around cash. So if the controls around cash are strong, then the auditor can reduce his substantive testing on the cash system. You understand, candidates? So if controls are assessed as strong and effective, then the auditor may reduce the scope of substantive testing. For example, the auditor will just have fewer detailed transaction checks. On the other hand, if controls are weak or controls are non-existent, the auditor will need to increase the nature, the timing, and extent of his own substantive procedures. Because in such a case, there is a risk of material misstatement. If the controls are non-existent, then there is high risk of material misstatements in the financial statements. And therefore, the auditor is required to carry out his own extensive substantive tests. You understand? Yes, you are discussing, candidates, audit planning strategy. So we've looked at the knowledge of the client's business, the degree of reliance on internal controls, and we now are moving to the nature, timing, and extent of the work performed. All right, nature. So number 3, we have nature. That's taken from our syllabus. We have nature, timing, and extent of work performed. Nature, timing, and extent. Nature, timing, and extent of work performed. So initially we had knowledge of the business, knowledge of the client's business, then we have degree of reliance on internal controls. Then number 3, you have nature, timing, and extent of work performed. Now, this element of the audit planning strategy directly flows from the knowledge of the client's business and the assessment of internal controls. So it flows from these two: knowledge of the client's business and degree of reliance of internal controls. It dictates what audit procedures will be performed, when they will be performed, and how much work will be done. So the nature and timing of the work, the extent of work to be performed, depends on the work he has done on the knowledge of the client's business. If the auditor has understood the business operations and strategies, understood the ownership structure and the governance structure, the accounting policies and internal controls, the auditor has evaluated the control design and implementation. If the auditor has understood the internal control system and has carried out the tests of control, then that will inform the nature, timing, and extent of the work to be performed. The nature of work. These are 3 things. Nature of work. So one, we have nature of work. Nature of work. This refers to the types of audit procedures to be performed. Nature of the work refers to the types of audit procedures to be performed. And examples include analytical procedures. Analytical procedures. It may include tests of controls, tests. The nature of work to be performed also includes substantive tests of detail. Substantive. It includes substantive tests. It may include things like observation. Observation is also work. So the nature of work includes analytical procedures. That means analyzing relationships and trends in financial data. The auditor may come up with ratios, liquidity ratios, and many other types of ratios, getting items from income statements, from the balance sheet, coming up with the ratios to understand the relationships and trends in financial data. The auditor may construct ratios from maybe 2 or 3 previous financial statements, financial periods, then compares with the current ratios of the financial statements under audit, so that the auditor can identify if there is any trend or if there are any deviations or any deviation from the norm or the standards, because you have industries that have standard ratios and all that. So analytical procedures refers to analyzing relationships and trends in the financial data. Then you have tests of control. That means evaluating the effectiveness of internal controls. Then you have substantive tests of details. That means examining individual transactions or account balances. For example, inspecting invoices or inspecting the receipts or bank balances and so on. Then we have observations, watching processes being performed like stock control and all that. The auditor can have also inquiry, asking questions from management, getting answers from employees, inquiries. So that is nature of work. Then there is timing of work. Timing. Nature, timing, and extent. So we have nature of work, then there is timing of work. Now, timing of work relates to when the audit procedures will be carried out. Timing of the work relates to when the audit procedures will be carried out, and some procedures can be performed at an interim date, that is before the year end, while others must be done at or after the year end. For instance, testing inventory counts might happen on the balance sheet date, while assessing internal controls could occur earlier in the year. So the timing often depends on the risk assessment and the effectiveness of controls. Timing. Then we have extent. Extent of work. What do you mean by extent of work? Extent of work. Extent of the work determines how much work will be performed, typically referring to the sample size or the number of items selected for testing. For example, how many invoices will be inspected, or how many accounts receivable balances will be confirmed, and all that. So the extent of testing is directly influenced by the assessed risks of material misstatements and the planned reliance on internal controls. So higher risk or weak controls generally lead to a greater extent of testing. If the records are developed in an environment of weak internal control system, then the auditor will have a larger sample. But if the internal control system is strong, then the auditor will have a small sample. So these are key areas in audit planning strategy. Key areas in audit planning strategy, which we defined as a high-level framework that an auditor develops at the outset of the engagement. It defines the scope, timing, and direction. And there are 3 key areas. That is 1, knowledge of the client's business. Number 2, we have the degree of reliance on internal controls. Then number 3, there is the nature, timing, and extent of the work to be performed. So candidates, these are 3 key areas. And by meticulously planning these 3 aspects, knowledge of the client's business, degree of reliance on internal controls, and nature, timing, and extent of the work to be performed. By meticulously planning these 3 aspects, the auditor ensures that the audit is conducted efficiently. It ensures that the auditor focuses on the key areas or the areas of highest risk, and ultimately provides a reasonable basis for forming an audit opinion. That is all, candidates, for today's lesson on audit planning strategy. In our next session, we're going to discuss the objectives of audit planning. Objectives of audit planning. Bye-bye.
Hi candidates, welcome to another session of Manifested Online Classes. We are still continuing with the topic of group account, and in this session, I want us to look on another concept of group accounts, and the concept is changes in group structure or disposal of interest. So when we talk about the disposal of interest, or basically changes in group structure, this whereby the parent company will sell all the shares held in a subsidiary, or basically sell part of the shares and retain some of the shares held in such what? A subsidiary. So therefore, what we're going to do here is we're going to look on how to prepare the group account whenever there is changes in the group structure, or basically we have now the disposal of what? Of interest. But before we even do that, we can have an introduction to this, and we say that changes in group structure occurs when the parent company sells the whole or part of shares, shareholding in the subsidiary company. So basically that's what we refer as the disposal of interest. So the parent company here will sell some of the shares, or basically all the shares which are held in a subsidiary company. Now generally the disposal of interest can be broadly classified into two main categories. First of all, we have what we refer as a full disposal. A full disposal is whereby the parent company sells all the shares which are held in a subsidiary. That is a full disposal. But on the other hand, we have a partial disposal whereby the parent company sells some of the shares held in a subsidiary and retain some of the shares. So therefore here we can talk of types of disposal of interest. So when we say there are two types of this, we say disposal of interest can either be, number one, we have the full disposal, and then we have the partial disposal. Disposal. But in accordance with the International Financial Reporting Standard number 3, a disposal of interest basically occurs when the parent company loses control. So mean that once the parent company sells some of the shares which are held in a subsidiary company, and the parent company now loses control. So mean that the shares which will be held by the parent company in the subsidiary falls below 51%. So actually from 50% to 0. That is the time the disposal is deemed to have occurred in accordance with IFRS 3, in which case then the parent company is required to determine something called the gain or loss on disposal. So therefore the gain or loss on disposal basically is determined when the parent company loses control. So therefore you can say according to IFRS 3, International Financial Reporting Standard number 3, disposal of interest occurs when the parent company loses control. the parent company loses what? Loses control. So basically what that means is that the shares now which are retained by the parent company, the subsidiary, or basically the parent company will sell some of the shares and retain shares which are less than 51%. Less than 51%. So that is the time the disposal take place. And in such a case, then we are saying the parent company should proceed and determine the gain or the loss on disposal. What is important, therefore, to note as far as that point is concerned is that if the parent company has retained a control, when talk about retaining a control, this whereby we can be told A Limited, which held 80% of the ordinary shares issued by B, the parent company we can be told like sold like 20% of the shares. 20% of the shares. What does that mean? It means that the parent company has retained 60% of the shares in what? In B. In such a case, you can see the parent company still having a control, because we said a company or an investor company will have a control of the investee, whereby the shares held by the investor company, the investee company, lies between 51% to 100%. So, but you're saying disposal in accordance with IFRS 3 occurs anytime the parent company loses control. It sells some of the shares here and retain shares which are now less than 51%, from 50% to 0. In which case we are saying a gain or a loss on disposal should be what? Should be determined. And therefore, you can say when disposal of interest occurs, that is when the parent company loses control, control, a gain or loss on disposal should be computed or should be determined, we can say should be determined as follows. So how do we compute that particular gain or loss on disposal of interest? So gain or loss on disposal of interest. So to determine this gain or loss on disposal of interest, number one, we take the fair value of purchase consideration received. So when the parent company sold some of the shares, or basically all the shares in a subsidiary, how much amount was received by the parent company? So that is now what referred as the fair value of purchase consideration received. To this we add the fair value of investment which has been retained. When talk about the fair value of the investment which has been retained, so this basically applies in case of a partial disposal, whereby the parent company has not sold all the shares in a subsidiary. If, for example, the A Limited, which is the parent, which initially had acquired 80% shareholding in B, which is the subsidiary, if, for example, the parent company sells like half of these shares, sells 40% of the shares held here, it means that the parent company has retained a shareholding which is equal to 40%. So at the date the disposal took place, the remaining investment will have to be revalued at its fair value, and always that figure will be provided to you. That's what we refer to as the fair value of the investment retained. So after adding those two figures, we come here and we less, number one, the fair value of net assets, held at date of disposal, So the fair value of the net asset held at the date of disposal, and then to this we also add the parent company and impaired goodwill. an impaired goodwill. And after deducting those two figures, we can get a positive figure here. If a positive figure, that is a gain, but if a negative figure, this is a loss on disposal, a loss on disposal, a loss on disposal. Yes, so this is basically how the gain or loss on disposal is determined anytime the parent company has lost the control. The parent company sells some of the shares held in a subsidiary, and therefore it retains shares which are less than 51%, from 50% to 0. Always in such a case we compute the gain or loss on what? The gain or loss on disposal. So then next we can proceed and look on how we prepare the consolidated financial statement anytime we have changes in the group structure. So let's look on the preparation of group accounts. So in this case, we're going to look on how we prepare the group accounts at different types of disposal. So remember, you have said that disposal of interest can be broadly classified into two: partial disposal and the full what? Disposal. Let's start with the full disposal. The full disposal. A full disposal generally is whereby the parent company sells all the shares held in a subsidiary. Sells all the shares held in a subsidiary. Maybe first of all, you can say that this is a whole what? Disposal, or basically a whole sale of shares in a subsidiary. So a wholesale of shares in a subsidiary company. And this one is basically governed by IFRS 5. So basically, in terms of how the parent company should treat that particular subsidiary which has been free disposed, that should be accounted for in accordance with IFRS 5, meaning that that subsidiary now will be termed, or basically will be referred to as a discontinued operation. Assuming we are told A Limited had acquired 80% shareholding in B Limited, and the parent company sells all these shares. So if that is the case, then this particular subsidiary is a discontinued operation, and should be accounted for in accordance with what? In accordance with IFRS 5. So what IFRS 5 requires is that the parent company should, number one, determine the gain or loss on disposal, and number two, the parent company should determine the gain or loss reported by that discontinued operation, and that one should be recognized, or those two items, the gain or loss on disposal of interest, the profit or loss from the discontinued operation, they should be recognized as separate items in the consolidated income statement. So therefore, we can say in this case, the parent entity or basically company should determine, or in other terms determine, number one, the gain or loss on disposal, the gain or loss on disposal of interest, and number two, the profit or loss from discontinued operation. We can abbreviate this as DO, from discontinued operation. And you are saying that these two items, that is the gain or loss on disposal and the profit or loss from discontinued operation, this should be recognized. This should be recognized as a separate line items in consolidated statement of profit or loss. Should be recognized as separate line items in the consolidated statement of profit or loss. Let's maybe from our group structure here, we introduce another company here, that is C Limited. We also assume that the parent company had a shareholding of 75%. So, and also we are told that the parent company, that is A, had 80% shareholding in B Limited, but we are told during the current financial year, the parent company sold all the shares held in B. So we have said B is a discontinued operation. So therefore, when A Limited is preparing the consolidated income statement, the consolidated income statement or the consolidated statement of profit or loss. So the parent company should first of all determine the profit or loss from the continuing operations. So the continuing operations will be the parent company and the NC, because you have said this one is a discontinued operation. So therefore, the parent company should determine what the profit or the loss from continuing operations. Continuing operations include A and C. And for the parent company to do that, basically, in this case, we take the revenue of this, that is A, plus the revenue of C. And then we also take the expenses, including the cost of sales of A plus that of C, We less that now from the revenue. We get, whatever you get here will be the profit or loss from continuing operations. Continuing operations. And then we are saying that these two items here should be added to the profit or loss from the continuing operations. So then we have the discontinued operations. Discontinued operation, basically you have said is this subsidiary which has been disposed. So two items will be included here: the gain or loss on disposal of interest. And you have to recall that this one is computed using that particular approach there, or that particular format there. And then we also have the profit or loss from discontinued operation. So how do we determine this a profit or loss from discontinued operation? So we take the revenue of this company. For example, the parent company sold the shares held in B Limited, for example, 6 months from the start of the current financial year. So in that case, you take the revenue of B for the first 6 months and also its expenses for the first 6 months, and then determine the profit or even the loss which was reported by that subsidiary B, which was fully disposed. You'll get the profit or loss from the discontinued operation. So if it's a profit, you add. If it's a loss, we do what? We less here. We less. And then we add that now to the profit or loss from the continuing operations. And then we get the profit for the year. The profit for the year. So that's basically how we deal with what referred as a full disposal. A full disposal. And basically, remember, these applies in preparation of a consolidated statement of profit or loss. Consolidated statement of profit or loss. So basically, when now preparing the consolidated statement of financial position, at the end of the year, the parent company will have fully disposed its shares in this subsidiary. So the parent company will not be having any control. Equally, there will be no NCI. So therefore, you can say that when preparing this consolidated statement of financial position, we can say there will be no NCI, or basically we can say assets and liabilities of subsidiary fully disposed are not included in consolidated statement of financial position. So the assets and liabilities of that subsidiary will not be included in the consolidated statement of financial position. And equally, as far as that subsidiary is concerned, there will be no NCI. The minority shareholders will not be entitled to share the net asset of that subsidiary as at the end of what? Of the year. That's basically how we deal with the what you refer as a full disposal. Then from there we have the other type of disposal. Recall in our case here we have said that we have two types of disposal: the full disposal and the partial disposal. Partial disposal. Now here we have different types of partial disposal. Actually, we can say we have different scenarios of partial disposal. Number one, or number A, we have what we refer as a disposal of a company which was initially a subsidiary and which still remains a subsidiary. Which still remain what? A subsidiary. A subsidiary company to a subsidiary. So when talk about a subsidiary to a subsidiary, this whereby we can be told the parent company had like 80% shareholding in B Limited, and the parent company, for example, sold 20% of the shares. So if it sold 20% of the shares, then it means that the parent company here retained 60%. So therefore you can see B Limited still remain what? Remain a subsidiary. So when it comes to preparing a consolidated income statement, what you do, you take the revenue and expenses of that subsidiary, you add to that of the parent. Actually, that disposal do not have any effect as far as the preparation of the consolidated statement of profit or loss is concerned. On the other hand, when preparing the consolidated statement of financial position, because this company is still a subsidiary at the end of the year, you take its assets and liabilities, you add to those of the parent. Actually, this particular type of partial disposal do not have any effect as far as the preparation of the group account is concerned. It's also important to note that here, because the parent company is not losing control, no gain or loss on disposal of interest is computed. This one is not computed because we have said we only compute that one anytime the parent company loses what? Control. So we can say no gain or loss on disposal of interest. On disposal of interest. So that is it about that scenario of partial disposal. So the other type of partial disposal, part B,